to share. Do you believe own Bitcoin because they understand what it's doing, why it's powerful, why it's important, how it's changing the world, versus those who are buying it because they want the number to go up, right? So it's obviously a mix of both. Do you have a sense of what portion of them are, let's call it sophisticated in their understanding of why Bitcoin exists?
I would generally say most of Bitcoin investors are investing because they believe or understand something. That doesn't mean they're proficient in Bitcoin. I would say that the majority, a significant part of our customers have never transacted an on-chain transaction, which is, by the way, complex for a lot of people out there. I assume here in the room, everybody can use their ledgers and Trezors and do on-chain transactions, but most people find it actually difficult to do on-chain transactions. So we simplify that to a lot of people. Therefore, a lot of them won't necessarily understand how blockchain technology works, which is why also we developed the Good Dollar project to help people understand how that works as well. So I think a lot of people are investing in it because they believe in the macro crypto asset as a hedge against governments, as a deflationary asset, and that's why they're investing.
Cool. All right, so one of the things that bothers me about Bitcoin's development is that it is the greatest decentralized system that mankind has ever built, and yet it has this profound centralization in terms of the exchanges, right? We have this huge centralization risk, and no one has really solved that. It's kind of one of the major flaws in how Bitcoin has developed so far. Caitlin, do you see this getting better? Is this something that can be solved? And if so, how? Is this always going to be a giant pockmark that we have to deal with?
I'm optimistic about DEXs because that does actually keep with the decentralization ethos. There have been, I guess if I step back, the way I would lay it out is we're making some of the same mistakes that the traditional financial services industry made. The reason why we don't like traditional financial services companies generally in this industry is because of the information asymmetry, where the traditional financial services company is the holder of the information, and you cannot have perfect markets if you don't have perfect information. And the intermediaries in this industry are not doing proof of reserves. They're not voluntarily disclosing their financial statements so you can understand the counterparty risk associated with them. And they're not disclosing the probability of losses on the products that they're offering. And in some cases, with 100 to 1, 125 to 1 leverage futures contracts, the probability of loss is in the high 90 percentile. And would people actually trade those if they knew that they were virtually guaranteed to lose money? I think there are probably a lot of innocent people who are way beyond their skis, and if we actually disclosed that information, you may see a lot fewer people losing money.
Well said. And tell us a little bit about Avanti and its commitment to being full reserve, and what that means as a bank. And do you believe that other banks might follow your lead, or do you look totally weird to them?
A lot of this really stems from the ethos of Bitcoin. Satoshi gave us money that isn't debt. And philosophically, why would you put debt on something? I like to use the phrase, a fool and their leveraged Bitcoin are soon parted. Again, a fool and their leveraged Bitcoin are soon parted. And the excesses that we've seen in this bull market are coming from a lot of leverage that didn't happen in the previous bull market, right? We had the ICO issue in the previous bull market. This bull market, it's leverage, right? We've seen more volatility. And one of the big issues with that is that even those of us who are not leveraged have the downside of the fact that the price is more volatile precisely because of the running of stops in these leveraged drawdowns, which we've just seen over the last month. It increases the cost of capital for everybody in the industry when Bitcoin's price is more volatile as a result of the impact of leverage moving it around. Avanti is fundamentally committed to not using leverage. And if you're interested in understanding why, philosophically, I really would encourage you to go read Mises. Go understand the difference between commodity credit and circulation credit. Commodity credit is absolutely fine. It's not leverage. Going one-to-one leverage is fine. Anything that is circulation credit that goes above 1 times leverage, in other words, certainly 100-to-1 leverage is is 99% circulation credit, right? That is creating claims to the underlying out of thin air. It is fractional reserve banking. And we are fundamentally committed to not doing that. It is ultimately a commitment to solvency instead of liquidity. And what we've seen in this bull market is a lot of folks are obsessed with liquidity. Satoshi didn't create anything that was designed to be leveraged and really didn't care about liquidity. One of the biggest takeaways that I have from this conference is what Nick Szabo said yesterday, when he said liquidity is a nice to have for a store of value, but not a necessity. You need to be able to use it when you need it, but do we need all this daily liquidity that's driven by trading? Go back and listen to Nick's speech and go read your Mises and learn about circulation credit.
Sam, do you agree?
I mean, I agree with parts. I think not with a lot of it. This is not shocking.
Tell us specifically about leverage from your perspective on this topic. Yeah.
So one thing I just want to say is that I think a lot gets blamed on 100x leverage, and I think it's sort of exaggerated. 100x leverage is not very important for any parts of the crypto industry right now. It's a tiny fraction of even the exchanges that have it, and it's not what causes the volatility that you see. The sizes that get liquidated on those positions are tiny. It's not what drives the big moves. The big moves are driven by big positions. And when you're talking about big positions, you're talking about low or no leverage. Leverage does absolutely play a role in it, but you're talking 3x, 5x leverage, not 100x leverage. 99% of the positions are in that lower range. Again, not trying to say leverage doesn't play a role in it, just that I think this sort of discussion about very high leverage is mostly a red herring. I do think there's a legitimate point about the volatility caused by leverage. It does cause volatility. That is undeniable. Liquidations cause leverage. I think that there's this side point people make about losing money because of that, and a lot of people have lost, and you should absolutely never put on a leverage position with more money than you are comfortable losing, because you might lose it, especially in a volatile market. That having been said, there's a difference between mean and median here, which I think is getting swept under the rug, right? And this is the same Petersburg's paradox, right? Where you could have a strategy that has completely decoupled probability of ending up above zero and expected value of net return. And the expected value is ultimately the more important concept there. Now, that's not to say you're not negative EV if you're doing 100x leverage, but you have to go further than just talking about probability of loss, right? If you have a 10% probability of 10xing and a 90% probability of going to zero, that's not a negative EV position to have on, right? And that's absolutely not something that you should do with a greater amount of funds than you're willing to lose. But that's not, doing that with 10% of your funds as collateral is not different than putting 100% of your funds in at 1x leverage, right? In fact, it's probably lower downside risk in some ways. And so if you reframe this from thinking about putting on too big of a position to not having to place as much of your capital at risk in order to put on the same size position, it changes the perspective on it a little bit. Again, not trying to say leverage doesn't play a role in this, just I think it's a lot more nuanced than that. And that might be worth it, right? If you think that it is very bad to have leverage in the system, that might be a trade-off worth having. But you can't just look at the drop from 60K to 40K and blame it on leverage without remembering that the run-up from 10K to 60K involved leverage as well. And we ended up higher than we started. And so just think about what you're throwing out, with the bad parts. Think about the collateral damage.
Well said. All right, so we just have a few moments here. I want to throw up a softball question that any of you can take. Are exchanges at risk of evolving into just another tool of state surveillance? What can be done to prevent that? And do we, as builders of exchanges, have a moral obligation to protect user privacy?
And so the question is about them becoming just like instruments of states to, you know, I think that like one thing I'll say is some absolutely will. There's nothing we can do that will make it the case that no exchanges are going to become effectively nationalized. We are already seeing it with some exchanges. There's nationalization going on with some of them. What can we do to combat that? First of all, have multiple exchanges, right? Don't put all your eggs in one basket. Even if one gets quite large, have others on standby so that you can move to one that you feel comfortable with if you cease to become comfortable with one of the current ones. I think that's just a key piece of this, and I think that's one of the problems that you see with the traditional financial ecosystem is that there's this extremely closely guarded ability to move a US dollar around, right? You can't hold your own dollar and send it yourself to someone. You have to rely on an extremely closely guarded list of ultimate counterparties to do that. And that means that you can't have a competing system to moving dollars around that tries to do it in a more efficient way or in a way that one feels more comfortable with. And I think that's one of the core problems is that you can't have an alternative to some pieces of the existing system. That's where all the pain comes from. And I think that our strength as an industry is the fact that we can build so many copies of this and we can have so many independent sources of exchangeability that people have choice.
All right, we got to wrap it up there, guys. Thank you for joining me on stage today.